I'm back. I had a lot going on there. I had my I had my what I had going on. My Wi-Fi. I wasn't hooked up on my Wi-Fi, so I was getting a little choppy there, choppy signal. Battery was kind of dying, so I had to come back. So definitely. So I am back, and I will delete the old video when it comes back. So guys, give me a thumbs up if you're just joining in. Blackout. Jay stay here said, yeah, I had to jump off and I had to come back. So anyway, I'm going to start the whole thing over. If you already heard it, I'm sorry about that. So you guys can drop questions if you are back. So anyway, so the topic is paying off your credit card before you start investing. I get asked a lot of times, Prince, I want to get into investing. What should I do? What type of stock should I buy? Da da da. Whatever the case may be, index, whether it's the forex, where is it? Any type of investment. And I say, okay, well, you have any debt? You own any debt? Some people may own a house. Some people may have real estate. Some people may have whatever the case may be. And let's say if you purchased a property and you're using that property to rent it out. I'm not talking about that type of debt. Or, hey, I have student loans. I always ask you, what is the interest rate, right? The number one killer is credit cards, right? Whether it's store-bought credit cards, maybe it's a Macy's or JCPenney card, or Amazon Prime card, whatever type of credit card it is, or Visa, bank credit card, any type of thing like that. Most of those things carry an interest rate of 10 to 20%. I don't care what type of credit score you got, you're paying some type of interest, right? So whether it's 10 to 20% in credit card debt, in the average household has over $15,000 to $20,000 worth of credit card debt. So if you do something that's compounding, something you see me talk on the show, compounding daily. Let's say if you're just paying 10% on a 10% of $15,000, you're talking about $1,500 that's going out of your pocket every single year. Average. I'm not even getting into how it's actually calculated day by day, compounded and things like that. So we're not talking about whether miscellaneous fees or whatever the case may be. So when I look at it, people say, hey, I want to get into investing, and I have to tell them the sad thing of, hey, I don't think you're ready to invest right now. I think you need to invest into that credit card. Pay that credit card off. You have a guaranteed return. Once you pay that credit card off, you have a guaranteed return, right? So every month, instead of putting money into an investment, into an IRA, into any type of investment, I would say, hey, stop this. Stop putting money into an investment and dedicate your money into your credit card. Once the credit card is paid off, then you can look into investment options. Because you got to think about it this way. Let's say if you did great on the stock market and got 10% return, 10 or 12% return, which most new investors won't do. Right? They're going to jump into something crazy, jump into something their friends will talk. 90-some% of them will do that. And 90% of them will end up being a loser. These are just statistical numbers. These are not my personal opinion, right? Because if you're like average investors or like myself, you had a little credit card debt, you want to get into investing, and it just seems so sexy. You hear on the line all the time. You see online, you watch on TV, oh, this guy who purchased Bitcoin 5 or 10 years ago, a person who brought Facebook, put their whole life savings in it 20 years ago, and I look at it now. I know Facebook hasn't been alive, on being publicly traded for 20 years, but you kind of catch my drift. They're not going to tell you the stories of the 90-something% of people who lost their money, because the stock market is here to raise money. Dropbox just went public. Spotify just went public. Why do companies go public? Companies don't go public so you can make money. No, companies go public to raise money from the public, right? You guys hear that? That means they're here to take your money to do their business. So if everybody was just opening up TD Ameritrade, Scott Trade accounts and just taking money out of the stock market would collapse. So if you go in, most people will lose. It's like a casino, right? But if you get smart and educated, it won't be like a casino if you're financially literate. But most people are financially illiterate, and they think that, hey, I want to be like the other people that I saw, so they invest a crap ton of money into the wrong thing and they end up losing their money. Now, let's put this back into context. I don't want to run down a rabbit hole. So if you guys are chiming in, you guys like what I'm saying, give it a thumbs up. And but anyway, so for prime example, if I owe $15,000 on a credit card, and let's say if my credit card is charging me 12%, If my credit card is charging me 12%, that means I'm losing 12% guaranteed annually, right? Even if I'm making a minimum payments or whatever the case may be. If I decide, hey, well, I want to get into investing. Now, let's say if you start investing your money and you lose your money, now you have a double whammy, right? Let's say if you even did good and you got the average market return, the S&P 500 on average, without calculating for inflation, returns historically about 10%. If you even make 10% return on your investment, your credit card is charging you 15%, right? Let's say if you threw $1,000 into investing and you made 10%, whoop-de-doo, you made $100 this year on investing, but you got a $15,000 credit card that's charging you 15%. Bam, you just lost what, $2,000 of investing. So you lost even more money. And by paying off your credit card, you give yourself a guaranteed return on investment. And the reason why I singled out credit cards is because, you know, if you got a, like I was saying earlier, if you got a real estate property and you rent it out and you make money back, or if you let's say if you got some student loans, but your student loans is charging you no interest, or maybe 1% or 2% in interest, if that's all it's doing, then you can maybe get into investing to offset some of those student loan costs. Because on average, if you are an index investor over time, you know, you're probably going to return maybe about 10%. Now, we all know the stock market will crash again. It may crash in 2018, it may crash in 2019, it may crash in 2020. The question, it's not a question of if it will crash, the question is when it will crash. And if you are someone who's carrying a credit card debt of 15 to 16% and you invest into a down market, you decide to go roll the dice, because I already know your mindset because I was there. Hey, you know what? What if I just throw some money here and boom, I can make it big and pay off my credit card? That's what everybody's, but that's a loser's game. You have to look at statistics, right? For prime example, I like to give you, let me segue a little bit into this. So I saw a story. Let's say, for example, if I went and bought a credit card, you probably heard me tell this before or whatnot, right? If I went into 7-Eleven and brought $1 and brought not a credit card, but brought a lottery ticket. I walk outside. Someone says, hey, Prince, I give you $2 for that lottery ticket. I already know what the average person is thinking. The average person is going to say, no, I'm not going to give you my lottery ticket for $2, because what if this is the winning ticket? What if I can win? You know, I want to win. It's that fear of missing out what's going to make me keep that ticket, that ticket. But now let's break it down to statistics. I brought a lottery ticket for $1. If somebody's willing to pay $2 for my lottery ticket, that is 100% return on my investment. I have 100% chance of being right, because a person is here, they're going to give me $2. I'm going to make 100% return on my investment, guaranteed, right? Now, when you think of it, when you put the statistical data there, why wouldn't most people just say, hey, have my lottery ticket, I'm going to make $2, and I can go buy another lottery ticket and just move on my life? No, it's the fear of missing out. What if I'm wrong? What if this is the big deal, right? What if this is the big shebang lottery ticket that can, whatever the case may be? And that thought process, when you look at the lottery ticket, if you keep that lottery ticket, you have like a 31 in 35 million chance of being right. So you have a strong possibility of being wrong, right, with that lottery ticket. So most people would choose a lottery ticket even though they know it's a loser's game and the odds are against them. The thing that drives their way of thinking is the fear of missing out. What if I'm wrong about Bitcoin and it takes off to $100,000 by the end of the year? Man, you know what? If I just throw some money there, that's the thought process that most people have. Even when it comes down to, now, Prince, what does this have to do with our topic of credit cards? This is why people don't focus on the credit card debt, because they say, well, boom, I can go buy this option. I can get into Forex. I heard about my buddy doing it. I can get into these cryptocurrencies, and, you know, it can flip to a whole bunch of money and I can pay off my credit card debt. It's the fear of missing out. The fear of missing out. No, even though I know with my credit card, I have 100% chance of being right. I get a guaranteed return on my investment if I pay this off, because I'm no longer giving 10% to the bank. I can give that 10% to myself. Most people will not do that because the fear of, what if I'm right about this option trading, or I'm right about this Forex, or I'm right about this future, I'm right about cryptocurrencies. What if I'm right about that? The fear of missing out. man, I don't want to miss out on this great opportunity, so I'm not going to pay off my debt. I'm going to throw it into this. And 95% of people that think that way, they're not going to pay off their debt, and they're going to end up losing in investing. So now they're going to be in a worse situation than they're already in. If you're smart, if you give into your retirement, great. You give into a 401k, great, or whatever the case may be. But I would cut back on everything. You know, if you was giving, I don't know, 10% to your 401k, drop it down to 1% or whatever the case may be, and pay off that debt. Because if your IRA or your 401k is making 10% a year, 12% a year, you have to look at what your credit card is killing you on. So get rid of the debt. That's the thing that makes us spin wheels. Once you get rid of that debt, I'm telling you, you're going to feel a whole lot better, right? And the thing about it is, people say, Prince, what are some ways I can pay off my credit card debt? The biggest way, you got to stop using it first. Stop using the thing. Take it from somebody who's been there and done it. You got to stop using the thing, throw it away or whatnot. Tell yourself, if I got to put on a credit card, I can't afford it, right? Put it away. Now the credit card is put away. Because if you're still using it, you're going to be spinning wheels. Put the credit card away, one. Two, if you got multiple ones, start off with the small one first. Say if you owe $10,000 on one, $3,000 on another one. Pay the minimum on the $10,000 on the large one, but put all your focus on paying the little one off. Once you get the little one off, then you move to the bigger ones, right? What's going on, TR? He said, hello, Prince. What's going on? So those are the ways. And also, if you're in collections or something like that, pick up the phone, call the bank, call the credit union, call the store, whatever, whoever owns that credit card, and say, hey, I'm in a situation. I'm really trying to pay your money back. I'm really trying to pay this off, or whatever the case may be. Can we work out a deal? Can we work out a situation to try to pay that credit card off? And those are some ways. Now, there are tons of other ways that you can pay it off. I won't say default. There's some ways you probably could default, or whatever the case may be. I wouldn't go into collection because that stuff goes onto your credit report. So, and which could affect you from maybe buying a house or something like that, you know, getting a loan or getting a business loan later on. So those are ways to think about it. Devote all of your money and all of your energy. First, stop using it. Then devote all your money and your energy to the smallest credit cards first and work your way up, right? Here you go. Thoughts of, okay, let me read a question here that I got. This is coming from Coat CEO. Let me put my finger here. Thoughts on putting funds towards paying off debt, car payments, use those funds in funding the business, or do the principle apply? Okay, I get what he's saying. He said, hey, should I pay off my car first, or should I put my money towards my business? I will say debt is a bad thing. What is the interest rate on your credit card or your car loan, right? Try to get rid of that first if you can, right? Now, the thing about it is, and the thing about it too, one of the mistakes I made in business, and I would try to, hopefully this advice will help you. When you start your own business, try to use as less of your own money as you possibly can. The reason why I say that is, I don't want to sound like I'm contradictory and saying, hey, go out and take a business loan or something like that. But let's say if you got $10,000 saved up, you take $10,000 and you start a business account and you start a business. If that business goes belly up, you lose the business and your $10,000, right? What I would recommend doing is say, hey, if you got $10,000, you want to start a business, try to get a business line of credit or try to get a business credit card or something like that. And the business name, it separates you. You still get to keep your money. So if that business goes belly up, you have to file bankruptcy, the business goes belly up, you have not drained all of your savings, right? So it's that thing, use other people's money. So, hey, if you can qualify for a business loan, you can qualify for a business line of credit. You keep your money in your savings. You keep your own $10,000. Start the business. You know, once the business is going, you can kind of make some payments out of your own money if you have to get the business on its feet, to start taking care of itself. That'd be great. But a classic mistake that I see people make, they take their own personal money and they start the business, and that's a very high risk because most businesses will fail in the first year, 2, 3, in the first 5 years. And if that business fails against you, you now lost the business and your whole initial investment. So if you qualify for a business loan, a business line of credit, now watch the interest rate. Don't get nothing out there 20, 30, 40%. But if you got good credit, I would try to use their own business, take your own money, pay off your debt first. Get rid of that debt, because the last thing you want to happen is your business fail, you put all your money into the business, and you still have the same debt. That's the worst case, right? And you got to look at the statistics. That's one thing I never looked at, as I got older and got into investing more, I became smart. Okay, thanks, man. Glad I could help. Became smart. Look at the statistics. You starting a business, I know how you feel, man. I'm smart. I figured it all out. If you didn't think it was going to be successful, you wouldn't start it. But look at the statistics. You have a 90-some% chance of this business failing. Don't take your own personal money, throw it into this. Who is this? Mayweather Financial Group. What if the business is selling puts, shorts, prints, way out of money puts? Okay, now Mayweather Financial Groups, now when you're selling puts, I don't want to get too far of anybody, but if you're selling puts, when you're buying calls and puts, these are option tradings for anybody out there that doesn't understand. When you're buying calls and puts, you have a high chance of losing. I don't know if this is the actual number, but you have a high chance of losing when you're buying calls and puts. When you sell calls and puts, you lower your chances of selling. People the losers usually buy the calls and puts. The sellers are the ones that usually wins, right? But this is the thing about it. Mayweather Financial Group. What if the business is selling puts? That's a very high risk business. When you get into option trading, those are derivatives. Not too many people are very successful with those, right? So if it all depends on how did you fund the business? What is your financial picture? This is not a cookie cutter for everybody, right? How did you fund the business? What does your financial picture look like? What is your current income? All those things have to be taken into account before I can sit back and say, hey, this is the way I would go. As of my level of knowledge and experience today, this is the way I would go. I would have to see your whole picture, right? I just can't say everybody go out here and do this thing. Some people may have a different picture. Maybe some people say, hey, well, I have a job, I have a promotion, I'm going to be making this much money in the future. I have, XYZ, I have contracts, or whatever the case may be. Your situation might be a little different. I'm making income from some real estates that I own. Your picture may be a little different. But to the average person, one of the classic mistakes I see is that, hey, I always wanted this restaurant. They go out, they take all the money they have saved up to start this restaurant. And if that restaurant failed, they lose the business. They also lose their savings, and they still have that same debt, right? So that would be my thing. That would be my way to look at it. Because if you pay off your debt, that's a guaranteed return on investment, right? Because we have to look at the statistical data. If you're going in Mayweather Financial Group, they may be great. They may be a cut above to be able to turn out net a profit. You will make money investing, right? It's like a guy who can't play basketball. You go out to the basketball court and you shoot the ball enough, someone's going to go in. Okay, Tucker Abdullah said, need you to do a video on REITs, real estate investment trusts. Let me write that down, real estate investment trust. As soon as I can find my marker, and of course my marker is not going to be here right from my dry erase board, but I remember that, real estate investment trust, all right? So we'll talk about them a little bit more. Or whatnot. I don't want to get too far into REITs right now, but they definitely should be a part. There are ways you can invest into real estate through the stock market, right? Mayweather Financial Group, do you think they give credit to portfolios like that when they ask what's the nature of your business? Now, granted, you're right, Mayweather Financial Group. If you go to a company and if you go to a traditional bank and say, hey, let me get a $20,000, $30,000, $40,000, $50,000 loan so I can go out here and invest. Most people are going to say no. Why do you think they will say no? They're going to look at the possibilities of this thing succeeding. They know most portfolio people are going to lose over the long run. So they're trying to make a safe bet that they're going to be able to get their money back. And if they do give it to you, it might be a little high on the interest rate. So you may have to take out a personal loan. You may have to, if that's all your business does, let's say if you say, hey, well, my business is a consulting firm. Inside of my consulting firm, we manage portfolios. We also consult businesses, XYZ. You may have a better chance to secure a loan. But if you walk into a traditional bank, even if somebody wrote me and said, hey, man, let me get $10,000 so I can go off here and invest. Now, they could be the next Warren Buffett. They could be the next Oliver Velez. They could be tons of people that are out here. But I know I'm looking at statistical data, the likelihood of me just finding that person, I have an 8% chance of being correct. which means I have a 92% chance of being wrong. And when I look at that, the odds are stacked against me. I'm probably not going to take that bet. So you can't fault unless you have a proven track record. You have a proven track record. If you have a track record of like dummy accounts, pay accounts, or something like that, that shows that you're very good at it and blah, 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 whatever, some type of business plan, some type of proposal where you have hard, concrete data that you have been trying this and you have a dummy account or you've shown that you've been doing this with real money, now you may have a chance. But to just walk in and just say, hey, I watched a couple of videos and studied some things and now let me get 10, 20, 30, $40,000 of, your money so I could, because the bank is there to make money. The only reason why they're loaning you money because they think they're going to make money. They're going to give you their money and make more on it, right? You guys already know how banks work. The person with a savings account, they're going to give you 0.025. To the person that comes to loan money, they're going to give them a 10, 12, 15% interest rate, and they're going to keep the difference in between. That doesn't work. The bank will go out of business if they handed out bad loans that defaulted, right? Look at 2008. When you gave a bunch of mortgages to people that had bad credit, what ended up happening, right? So those are things you got to think about. A bunch of people default on their loans. And business is already hard. So if you walk in saying, hey, I just want some money to do this. Yes, banks are institutional investors as well. They're invest as well. They're the ones that buy, a lot of stocks and things like that as well. They're institutional investors. And they also they have other private investors that handle their money as well, right? Because most of the time when you call in your banks, they have a lot of back office people. So I don't want to run down a rabbit hole of, getting into institutional investors and things like that. But that's something to think about. If you have credit card debt, if you owe credit cards, look at that. Is a commercial bank better than a credit union loan? I mean, when I look at a commercial, it all depends. At the end of the day, if I gave you $10,000, if Bank of America gave you $10,000, if JP Morgan gave you $10,000, what would be the difference? $10,000 is 10. If Warren Buffett gave you $10,000, it's all the same, right? The $10,000 of you. To me, what I'm going to be concerned with is the interest rate. If the credit union give you a better interest rate, historically they say credit unions give you a better interest rate, right? But it all depends on the interest rate. Who would give you the loan at what interest rate? If you got it from, any other institution, what's the interest rate on it? What are the conditions? How do you have to pay it back? That's the biggest difference, to the best of my knowledge on loans. When I look at a loan, who's giving me the best interest rate? What's the brand? Who I like dealing with? That type of thing. So interest rates are key. Yep, exactly, right? What's the interest rate? Sometimes a commercial banks or local banks may beat a credit union. Sometimes a credit union may beat a nationally, globally loaned bank. So at the end of the day, it's what's the interest rate? Interest rates are key. Think about it, when you go buy a car, they just tell you what the monthly payments are. Oh yeah, look at this car. It's only $250 a month. Oh wow, that's it? You can afford that? Yes. No, they're not telling you what's the overall loan, what's the length of the loan, what's the interest rate. That's how they get a lot of young guys, right? What is the best return payment agreement? Well, usually the best return on investment payment agreement usually comes from private investors, right? And banks. Private investors are number one because they're usually a little bit more lenient and flexible, things like that. And, banks are number two, right? That's a hard question to answer because it depends on your situation. Of course, the best one out there, if I'm someone receiving the loan, the best one is I don't have to pay anything until I start to turn a profit and you get a percentage of the profit. That's the best one. The reason why that's the best one, in my opinion, is now that investor has skin in the game of me doing well. Let me explain. For prime example, if I wanted to own a McDonald's and they told me, hey, give us $1 million and we give you a McDonald's franchise, versus if I went to own a Wendy's and they said, hey, give us $500,000, we'll give you the franchise, you're going to pay us back 10% of your gross or 10% of your net or whatever the case may be. Now, if the company is getting a piece of my gross, the higher my gross is, the more money the company makes, right? So they have an invested interest in me doing well. So if I have a bank or or any type of investor, you want them to have some type of skin in the game of you doing well. Because if that franchise has skin in the game of me doing well, they may look out for me. They may pay some. If I get to a point where I'm getting down, I think about the collapse, they'll look out for you because they have skin in the game. So I would say the best return on investment agreement is one that the investor has skin in the game of me doing well. All right, they have an invested interest in me growing this platform, which meaning they may lend you some more resources if things got bad for you, which meaning they may give you some consultancy or something like that. But I look at someone they call getting in bed with you or skin in the game or having an invested interest in you. You know, they make more money as the more money that I make. It's like if you got an investment advisor or a financial planner, you want a fee-based one, right? One that takes 1 or 2% of whatever they're managing. Because if you give me $10,000 and I'm managing $10,000 and you give me 1 or 2% of what I'm managing, if that 10,000 turns into 15, 20, 30, or 100, that's the more money that I'm making, right? Versus if you was E-Trade, they don't care how much money you got in the account. They just want you to buy and sell. That's how Wall Street makes its money, by us buying and selling. That's how TD Ameritrade, E-Trade, Scott Trade, whatever the case may be. Robinhood, I don't know what the heck they're doing. I think they have a different investment strategy. I think that they are looking to grow their platform as big as possible and, I don't know, sell advertising. I don't know what their game plan is on royalties, nor have I looked into it or desired to have that look into it. But they have a lot of big investors behind them that's funneling them up, and they're probably going to look to do something later on to make money from it. So I hope that helped. Hope I didn't ramble too much. For the people that's catching this live on YouTube and the podcast, for the people who haven't checked out the podcast, we're on everywhere, pretty much iTunes, Google Play, SoundCloud. You know, go through on your phones, your mobile devices, and go to Google Play Music and find the Investor Show. Go onto iTunes and find the Investor Show, catch the podcast, or SoundCloud, or Stitch Radio, all these other random ones out there. So, and follow us on Facebook and Instagram and stuff like that. You like the channel, you like the brand and what we do, you want to support us, check out our books. Wesley Learns to Invest. Wesley Learns About Credit. The children's books teaching kids about investing and credit. Check those two out. Download an audio book if you want to. It's only, $2? Download an audio book, download a ebook, or give away to your kids, or whatever the case may be. So yeah, support. Hitting accounts on spillage. Whoo! He says Robinhood make their money on hidden accounts for on spillage. Well, that's one way. You know, I think they got some. You know, they need to come up with some better ways. I don't know. You know, trade fees have gone down. E-Trade is only at $6. I remember when it was at $9. Now $9 is high. So, but yeah, I'm not going to be on here too much longer. I've been on my water diet all day, reading and stuff like that. Oh, yeah, J. Rodder. Oh, it's true. Yeah, that's Chad. Global Children's Financial Literacy Foundation. Support our new nonprofit, Global. Who put 85 cent TR? I don't know what that is. But Global Children's Financial Literacy Foundation. Check us out, childrensfinancialliteracy.org. Also, check us out on Facebook, Children's Financial Literacy, Global Children's Financial Literacy. You know, yeah, definitely stay on the lookout for our nonprofit, the things that we're doing, especially, you know, around the globe that we've been doing. Appreciate that. But I'm not going to stay on here too much longer. I got to go find me something to eat. Been drinking water all day and reading, so hopefully I don't look too rough and crazy. Yeah, exactly. $4.95? Are you sure it's $4.95? On All Trades TR, who just wrote that? But yeah, drop the comments below. I gotta get out of here. I've been on here for 30 minutes now. Is it $4.90? You sure? Or is it $6.95? Okay, maybe it's $4.95. Somebody say go eat, bro. Yeah, definitely. So yeah, definitely thank you guys for tuning in. Don't forget to hit the like, subscribe, comment, share button. Support all our things. Support us on all our platforms. Definitely appreciate all the support you guys been giving us. Appreciate it. I'm out of here to the next video, podcast, cartoon, or whatever you see me Around the globe, 495. Okay. Hey, there you guys got it. 495 E-Trade. I like that. See, I remember it was 995. Right, $10. Trade fees are getting lower and lower. But anyway, peace. Be safe. I'm out. Thanks.